Danny, we're back doing Market Mondays again.
We are.
Obviously, on a new platform, so it's probably going to have some, I suppose, little hiccups along the way, like not unmuting your microphone before talking. But it's good to see you again. Happy February.
Happy February. Happy New Year, I guess, to everyone. And yeah, let's get the show on the road, back on the weekly grind.
That's it. Maybe we'll start with just a quick mention of the disclaimer, which is obviously that anything that you hear here is of general nature only and doesn't take into consideration anybody's personal circumstances. Seek out financial advice.
Yeah,
Uh,
and
Elect-
also just be aware of the products that we offer at Capital.com. They do carry a high level of risk, whether that's spread betting for those of you in the UK and also CFDs. So just be aware that before you trade any of our products, that you are aware of the risks that they involve.
Absolutely. Let's start things with where the volatility is at the moment, which is, I mean, in a broad sense, basically everywhere. But I think precious metals has been the thing that has garnered the most attention, and certainly, as we can see in the data, the thing that clients are trading the most. You can kind of see the popularity of silver climbing up the ranks over the last few months. Is obviously we had that sort of silver surge, gold the perennial favourite amongst retail traders, but how have you perceived things over the last week and a half or so when it comes to just the precious metal complex? Because, for me, at least when it comes to the narrative of the last week and a half, everything sort of starts and finishes there.
Yeah, I mean, it's been an interesting. I think the run up to kind of the chaos was interesting as well, because we've seen in the past that silver tends to be the more speculative of the two out of gold and silver, and usually we see those exponential moves in the silver market. But interestingly enough, kind of the week or 10 days before the significant pullbacks that we saw, around 10 days ago now, we actually saw that kind of gold took that position a bit more. We had seen a little bit more two sideways trade in silver. We saw some sellers challenging the upside, whereas in gold we saw about 7 or 8 sessions of straight upside, no real challenge to the momentum. So gold was also becoming highly speculative, and I think that's what really started to catch a lot of people off guard. And then essentially we kind of saw that recalibration in the market. A lot of it having to do on, there were several factors really. We've said a few times, the fundamentals haven't really changed. The long-term potential as a store of value, as a hedge against political and fiscal uncertainty or even wrongdoing to some extent, that still remains in place. However, it got to a point where it became a little bit too volatile, a little bit too hard to enter the market at those levels. Portfolio rebalancing at the start of a new year also played a key factor. That a lot of portfolios having to kind of get rid of large gold and silver positions, given how much the surge in price had led to overweight in some of these portfolios. Of course, then we saw this liquidity crunch, having to liquidate other parts of the market, other parts of the portfolio in order to keep up with the losses. And it kind of started to feed this momentum that we saw really break at the beginning of last week. And we kind of saw that negative bias really spill over into the rest of the market.
Yeah, I think if you look at basically the price action of the last week or so, you can see that things have become highly correlated, and that's pretty typical in a volatile market. And we are seeing relatively elevated volatility. Certainly, obviously, in precious metals, crypto is another one that's worth mentioning for those jurisdictions that obviously can trade or take interest in it. But even equities, we saw the VIX back through I think 22, 23, and the critical obviously. You outlined the kind of narrative there leading into the highs and then the kind of crash that we saw a week and a half ago. But I think really what we're seeing now is a market somewhat divorced from fundamentals, dislocated in many respects, and it's this build-up of leverage that occurs obviously in environments where things become rather speculative. And the clearing out of that leverage, which is basically meaning there are traders licking their wounds and nursing some fairly significant loss-making positions and having to sell other areas of their portfolio in order to be able to cover those. There's obviously more to it. You've got the kind of impacts of momentum sort of strategies, those kind of what would you say? Can't remember the systematic sort of trading strategies, driving sort of momentum in both directions. You've also got that kind of, element where, retail is sort of dipping their toes back in here and there by way of anecdote, where a floor above a bullion dealer in the Melbourne office in Australia, and there are literally lines out the door to get, obviously gold predominantly, but also people wanting to buy silver as well. So there's that element adding to price volatility. But for the most part, this is a highly technically driven market, driven by the flows from the fallout of that kind of correction. And we had sort of gold and silver up, I think silver's up again at like 5%, 6% as we speak, gold up a couple of percent. This kind of price action tends to work in sort of reducing the amplitudes, almost like a fishtail effect. And for now, we aren't really seeing anything other than, markets sort of behaving in response to those kind of, again, technical factors.
Yeah, I guess one of the things that stood out to me is a lot of the financial media, the reporting that we saw during last week specifically, a lot of them were trying to make that distinction that this was essentially a technical correction, and it didn't really affect the long-term fundamental of precious metals. And I think that's interesting. We were trying to constantly sell that side of the story. Look, this is just something that's got to happen when price gets so punchy and valuations, even in the metal sector, they get a little bit overstretched. We need that correction in the market, and that needs to just rebalance the price and that recalibration. So I think the key question now we get is, what do we expect now? We've gone, and you can see, the viewers can see the charts here. We've got both gold at the top and silver here at the bottom. And you can see, as I was saying earlier, just that momentum build up here in gold, how strong the build up was. No real test along the way. We saw maybe 3 days before the actual breaking, a little bit of selling momentum. But if we compare it to silver, when we did see a little bit more test of that upside, that really shows kind of how speculative the market had become leading into the pullback. You can see here quite dramatic, obviously more in silver because the percentage is just bigger given the smaller price, a smaller base. But yeah, we've seen some significant moves. We're now rebalanced, sitting around the levels where we were at the end of 2025, both for gold and silver. So the question now is, we're a month into the year. We've kind of seen a lot of volatility. What can we expect moving forward? Are we going to expect to see, the metals market continue to be so jumpy for the foreseeable future? And I think, as we've said, the fundamentals haven't changed. I think, once we've kind of overcome this situation right now, I think investors and traders still see the upside in both gold and silver. And you can see today, as you were saying, up about 5% in silver so far, about 1.5% in gold. People are still looking to enter and to take advantage of the long-term appeal. But again, there's likely to be a little bit of concern, a little bit of caution as to maybe this volatility isn't fully over yet. Maybe we do still see a little bit more sideways trade, maybe some sideways consolidation, two-sided trade before we actually see that long-term appeal return and really test those highs that we marked before the pullback.
Yeah, it'll be sort of fascinating to see if we continue to see gold and silver trade in, I suppose, a fairly tight correlation, because I guess the argument would be, given that silver is much more prone, or is a little bit more prone to kind of retail speculation, as to what extent price did become divorced from supply and demand fundamentals, and whether fair value is something with, say, a 7 in front of it, or whether it's still sort of something with a 4 or 5 in front of it potentially, which doesn't necessarily speak to sort of the long-term story, because we've been discussing for a little while that there is obviously sort of secular demand there for silver as an input into some fairly critical industries. But that doesn't necessarily mean that in the short term we're going to see prices kind of hold around these still very elevated levels. The move in gold and silver, gold's back above 5,000 today, it has to be said, so it's only sort of down 10% from the record highs. Silver's down by a lot more, but it only wiped off basically to this point about a month of gains, if even less than that. It really does beg the question whether this is representative, at least for silver, of fair value, and with price is still moving 3, 4, 5+% a day. That's not a healthy market, even if it's moving in the bullish direction. it's not a market that's really responding to fundamentals. I mean, in the space of 12, 18 hours, the supply and demand dynamics in silver haven't changed that much. So it suggests that, yeah, effectively we're still sort of trading in a way that is, again, dislocated from the fundamentals, a little bit irrational, being driven by these sort of technical things, which is fine. But I think for traders, it just sort of pays to know what you're actually trading. That, if you're a real sort of silver bull and you think, well, this is a sign of, a really strong fundamental, kind of demand driver, I would dare sort of challenge you on that and sort of suggest that, actually this is still a lot of noise, and that, a bullish call in the short term on silver isn't one based on necessarily fundamentals, but these other things. But I don't know if we want to zoom out and talk about some of the other key issues at the moment in the markets, and arguably what I've sort of referred to as, the pin that pricks the bubble for precious metals, and then, by extension, the moves in Bitcoin and at different stages equities too. It's just the prospects of Fed policy going forward, especially now that we know that we've got Kevin Warsh coming in, or we don't know that yet. He has to be approved by Congress, but he's been nominated as the next Fed chairperson. It's likely he'll have the role. And that is causing some, interesting sort of gyrations in markets, by way, I suppose, of the US dollar, which has been beaten up because of the, I guess you could say, uncertainty that US foreign policy and trade policy threw at the currency throughout the month of January. But for all intents and purposes, and has recovered off the lows. And for me, the dollar's fundamental story remains really strong. I think it should be higher if it weren't for this kind of, political risk premium. But I mean, obviously there's that kind of debasement trade that everyone keeps talking about too. What's your view on that? Because, Warsh wants rate cuts. There's this political risk premium, but the US economy is, the still strongest anywhere in the world, especially sitting in the part of the world that you are in Europe after the ECB and BOE. What's your view on the dollar and the currency complex?
Yeah, from a rate differential perspective, I do agree the dollar should be a little bit stronger. It's got all the backing it needs. I mean, as you said, from a growth perspective, still very strong, relatively very strong compared to other economies, specifically in Europe and the UK, if you look at it separately. In terms of inflation, the inflation mandate remains pretty much unchanged from where we were at the end of last year. Still monitoring specifically the services inflation, domestic inflation, but they still have a little bit of stubbornness in inflation, and again limiting that downside potential. The thing with Kevin Warsh is a lot of people kind of viewed him as a hawk, or expected to see, keeping the higher for longer narrative. But at the end of the day, him being picked by Trump does suggest that he has leaned in more to the dovish narrative. If you've seen some of his latest comments, you do expect to see also some rate cuts. And I think it stables out the picture. I think a lot of the uncertainty that we've seen in the last few months was who's going to be the next Fed chair, what about Fed independence? And I think maybe this change in leadership, especially from the view that, this is a fresh pick from Donald Trump. Everyone is essentially, so was Powell at one point, but right now he is the fresh pick, so we'd expect the Fed to have a little bit more confidence and to be, I guess, to some extent left alone a little bit more by the Trump administration, which this mingling within the Fed mandate and kind of the fears of intervention and replacement, that's again been one of the drivers behind the de-dollarization, debasement trade, and kind of moving towards that sell America trade, which has been weighing so heavily against the dollar, even though fundamentally it's still got some long-term appeal from that rate differential. So I do think, as you said, the dollar could be higher. It's just got that kind of risk premium that's been limiting the upside. Interestingly enough, that push higher that we saw throughout last week, which coincides with a lot of that volatility that we saw in precious metals, also people selling equities as well as those correlations grew, we kind of saw the dollar move higher. And that kind of saw a little bit of respite in that selling pressure. But once again, you can see today, as soon as we've seen that those nerves settle a bit more elsewhere, we're back to selling the dollar as well. So it's going to be interesting to see how this momentum continues. In terms of Fed policy, we don't have that much insight. We had the meeting recently, again, pretty much staying on that just wait and see will be very data dependent. And I think also a very interesting story with the dollar is that dollar yen cross, which I'm sure we'll talk about in just a second because of what's happened in Japan over the weekend. But yeah, dollar yen's been very interesting. Once again, talks about intervention given the weakness in the yen, which is expected to continue given its fiscal outlook. So it'll be interesting to see how the dollar index performs across the board.
Yeah, I think, sort of you can see in sort of today's price movement that is very much reflective of probably the knock-on effect that the news of the day has had out of Japan. And we saw some quite interesting price action at the open, which was more or less a gap higher for the currency. I should say gap higher for the USD JPY, so the yen depreciated. And the basis of that is, of course, that we've seen the yen depreciate quite significantly as the BOJ keeps relatively accommodative policy settings at a time where obviously inflation is remaining pretty elevated. And this whole election and this whole Takaichi phenomenon is built upon this sort of big spending fiscal agenda, which is more or less sort of feeding these fears of Japan's own sort of debasement trade, if you will, and the yen has depreciated as a result. But we did get, after that initial move, some comments, and I can't remember, it was the currency czar over there in Japan, saying, and this was this morning, that they're watching the currency with urgency or something like that. They have that kind of rhetoric and that kind of really bizarre language that they use to sort of jawbone these things to signal to the markets that, we're on top of this and we're watching what's happening. That happened once again. And I think this could be a really sort of fascinating market to watch, one that's going to be risky and quite difficult to predict. But we saw intervention at the middle of January or thereabouts. I think the Ministry of Finance released its currency report or whatever it was, and the data there confirmed that there was some degree of intervention in the market in the currency last month. The fundamentals are going to continue to push the yen lower, all else being equal. And really the key variable there is if the BOJ starts to shift its tone a little bit and speak a little bit more about hiking interest rates in the future. But if that doesn't happen, the yen's going to trend to the downside, all else equal. And that means that pretty much the markets are going to be on intervention watch. And you saw it today. We got close to sort of 158 again, and those verbal warnings came out. But this is like sort of pushing the proverbial beach balloon under the pool water. You can try and hold it down there, but it's going to keep popping up without, in this instance, changes to policy settings in Japan.
Yeah, we've kind of been tracking for a while. I mean, we saw before that sell-off and that real, talking up of intervention, as you said, actual intervention in the market. It's been testing those highs. In the past, it was 150, then it moved up to 155. It's now, a lot of people have their eyes set on 160, but as you said, as soon as we kind of get towards these levels, markets now expect to have that intervention. And the first part of intervention is verbal intervention, just talking about it, suggesting that you could be close to actually intervening. That in itself is the first step and the first reaction in markets. So it'll be interesting to see how this evolves over this week, to see how much of that talk markets are actually taking in stride and actually believing that we're likely to see another significant sell-off in dollar yen. As you said, with no real fundamental change, it's unlikely that this will be sustainable in the long term. Now, elsewhere, if we look, for example, at equity markets, a big focus of the last few weeks has been the earnings season, and specifically the tech sector. So we've got the NASDAQ chart up here just to show that alongside metals, we have seen a pullback in the equity space. In general, we've seen it across the globe in Asia and Europe, in the US, but the tech sector has been heavily sold off over the last few days. And that is mostly on the back of, once again, those concerns about overinvestment in the AI sector flourishing. From the offset, the actual earnings, the data reported has been pretty good from the key tech companies. However, once again, investors have been looking with a very, very close eye for any cause of concern, for any, issues along the way. And it's not enough to just report good earnings anymore. You have to justify where future earnings are going to come from, and the money that you're investing now, specifically very large amounts in the AI sector, how you're going to justify those returns in the future. And we saw, I believe it was it Alphabet? I forget, Alphabet or Microsoft? Alphabet, I think, right? That they reported an unexpected increase in capex in the
Amazon
future.
on Friday was the big one. Got
Yeah,
smashed. Microsoft was the same. That was they got punished as well,
yeah.
but Amazon got beaten up.
So basically, the narrative we kind of take from this tech earnings is that, the bottom line, the figures are holding up, and nothing's really changed from where we were last year. However, looking to the future, they are all increasing their expenditure, specifically not only in AI, but a big chunk of it is going into that sector. And once again, investors are concerned, how much of that are we going to see as real return? Maybe are they getting a little bit too punchy with spending in this sector? And I think that's where we've seen a lot of the sell-offs come, specifically in the post earnings.
Yeah, yeah. I mean, you can sort of see it in the response to the results as they get dropped, and obviously, with the time zones of the way they are at the moment, being in Australia is quite well placed to watch the response in markets to these results. But immediately, the first thing that the markets respond to is the capex figure. Even Meta, a couple of weeks ago or a week ago, dropped 7 or 8% because their capex number completely exceeded expectations, absolutely blew expectations out of the water. And then there was a bit of a recalibration in the market, saw that actually they were lifting guidance, and there was all these other things to offset those concerns. But the knee-jerk reaction is basically on capex. And it's kind of a question, to what extent are companies, in order to try and stay ahead of the game here, and capture, obviously the returns on offer from artificial intelligence, sort of running into kind of somewhat diminishing returns. That sort of extra dollar of spend is capturing, less of the pie. And you can sort of see, I think, last week as well, the kind of cutthroat stage that we are in the AI sort of investment cycle with the Anthropic news, which is effectively to say that if you're not there with the next breakthrough, and positioning yourself as the leader in your market, and whatever that niche in AI happens to be, you're going to get absolutely cooked. I mean, we saw the software stocks, plunge. We saw finance companies tied to software stocks, plunge on fears that, there'll be issues with creditworthiness and all these sorts of things. So all of this money is going in there because effectively, and this is where bubble dynamics come into it, is that, the hyperscalers are damned if they do, damned if they don't. They spend the money, they burn through free cash flow a little bit, they might leverage up and that hurts their share price. But if they don't do it, then they're going to be left behind. So we're in this really interesting dynamic. But I mean, the flip side of this, maybe we can sort of talk about the divergence in performance here in global equities, is that there is not a wholesale sell-off happening. There's a rotation going on, and we saw, I hate the Dow because it's a BS index, but it's through 50,000. Asian equities, for the first time in a while, are outperforming their US counterparts. And there's a desire for cyclicality, which is kind of this, view that even maybe as multiples compress in tech, maybe contributing to the multiple compression in tech, is this sort of rebound that we're seeing in global economic activity. Not tremendously so, but certainly that things are heading in a better direction at this moment than they were, say, 6 months ago, when everyone was sort of clouded by trade uncertainty and the rest of it.
Yeah, it's a tricky one with the tech sector because you can never really, kind of declare it defeated, really. I mean, we've seen in the past, we've seen the start of rotations. We've seen people say, okay, no, we're looking for value stocks. Tech has become overheated, overstretched. There's no real appreciation potential in the sector that's become so overcrowded. And then we kind of see that all undone and people piling into the tech sector once again. So I think the rotation is definitely happening, both from a sector perspective, but also from a country perspective. We've seen this in the past. People moving into Asia, also into Europe as well. We saw actually the DAX, for example, in January, very, very strong before we saw that a correction as well take hold. The Stock 600 as well in Europe. outperforming the US market for a while there as well. So there's definitely potential to move out and away from the US and into more, I think, unexplored right now markets. But I think you've always got to keep your eye out on tech, because we do seem to be in this never-ending situation where they just continue to find that appeal to attract more investors and to keep pushing higher. And of course, a lot of that being on that double-digit growth that they continue to show quarter after quarter, which is something that you can't really deny. Kyle, in terms of market, I think we've gone through much of what's been happening over the last few weeks. In terms of the economic calendar, we've seen most of the central banks, the key central banks, report now for the start of the year. I believe we have the NFP figure, the US jobs data this Wednesday, which was actually pushed back from Friday, and a story that maybe didn't garner a lot of attention, but we had a kind of second, this time it was a partial, but we did have a government shutdown, US government shutdown last week that lasted about 4 days before Donald Trump actually signed a bill to end it. And that led to the pushing back of the release of the US jobs data. So that's on the calendar this week. And we'll have to watch out to see how the growth in the sector continues. I think the data is expecting to see unemployment unchanged around that 4.4% mark, with the actual non-farm payrolls expected to come in around 75,000. We did see, I think it was about 50,000 in the month prior. We know the data's been a little bit skewed as of recent months because of the previous government shutdown at the end of 2025. What are you looking out for on the calendar, Kyle?
Yeah, I mean, we've got that. That'll be the most important release of the week. And then we've also got that inflation data at the end of the week. And it sort of obviously remains a question of, to what extent is the labour market deteriorating versus, inflation remaining fairly sticky. And on top of that too, what is it that's actually driving this labour market weakness, or at least a slower hiring, whether it is a sort of a demand thing or whether it's actually tied back to some kind of supply side story, whether it be artificial intelligence or immigration policy, something that we've been talking about for the last 12 months. But it's going to be interesting now that we have a nominee for the next Fed chairperson, because it increasingly makes Powell effectively a lame duck Fed head, and the markets are going to be asking the question of, okay, well, what does this mean under the Powell Fed versus the Warsh Fed? And you'll see all sorts of probably interesting permutations in the rates curve as the markets try to price that in. I mean, ultimately, there is still this view that there's going to be a slightly more dovish skew on the Fed by virtue of Warsh's nomination. That will mean that the labour side of the mandate, or the employment side of the mandate, will be prioritised. So if we do see sort of a weak number there, that could conceivably bring the odds of a rate cut forward a little bit. It's not really in the price fully until the second half of this year, but it's going to be a messy one, because inflation is still sort of with a high 2 in front of it. All indications are that it's pretty sticky, and that without that coming down a little bit, a cut's going to be fairly difficult. But yeah, I mean, effectively, as long as that employment number is going to be crucial, it's going to tell us about that timing of the next cut. And if we still get that kind of fairly moderate slowdown in the labour market and the odds of a cut sort of lifting, equity markets I think will lean into that pretty heavily.
Yeah, I think that would be the perfect excuse to kind of reverse and move higher a little bit. Yeah, as you said, a very interesting week, because we've got the labour market data on Wednesday, and then, as you said, that inflation data on Friday, which is, of course, the dual mandate of the Federal Reserve. So it's going to be interesting to see how those figures play out and how the actual data leans, against expectations, and how markets reprice that and recalibrate in the market. And as you said, we kind of do have two sides of the Fed right now. At the end of the day, my view is that the Fed, the central bank, no matter who is at the head of it, they can't ignore the data. So data continues, for me, data continues to control the narrative. However, the governor will decide, the commentary around it, and finesse and tweak the delivery of how that data is perceived. So I think in that case, it's going to be very interesting to see, now that markets are almost certain they know who the next Fed chair is going to be, how that changes their perspective, if at all. Kyle, I think we've covered mostly everything from my side. Thank you everyone again for joining. We're back with these, so we'll be back every Monday giving you what's the latest in the market. Kyle, thank you.
It's great to see you again, Danny. We'll do it again next week.
Bye, guys.